CNBC's Hugh Son, who works for .com, has been reporting the heck out of this entire story, Hugh, as we continue to compare sort of the CS Nomura camp with the Goldman Morgan Stanley camp and sort of ask broader questions about what exactly prime brokerages have learned about visibility, transparency, collateralization since the crisis.
Hey, Carl. I mean, look, I think this is a perfect example, right? You rarely get such great examples of the difference in risk management and letting it unfold in the public view. You have Goldman Sachs and Morgan Stanley, which are the number 2 and number 1 prime brokerages in the world. They generate the most revenue. They have the greatest scale. They have the greatest reach and the most sophistication. Getting out of this trade, even before the time that Credit Suisse and Nomura have to disclose that they are experiencing material losses. So this shows really the difference in sophistication. It shows that perhaps, at least at the very top of the league charts, that the biggest prime brokerages have learned a lesson from previous blow-ups and from the 2009 crisis, and that if you're, outside of the top 5 or 6, and you're seeking to break into prime brokerage and to lead on price and to lead on, maybe we'll take less collateral, that, sometimes that comes back to bite you.
Yeah, Hugh, I'm curious. I mean, we're starting to see those reports that, obviously not all banks were created equal in terms of how this margin call played out, this liquidation event across these different banks. Was it really sort of a race to be first in terms of placing those sales? And if so, is that something that now changes? I mean, could you potentially see more communication or not?
Well, so Morgan, one thing that is very material to the question you ask is in the days before this spilled into the public view on Friday, the 5 primes got together with Bill Hwang, and they tried to, they tried to have a ceasefire. They tried to do a more orderly liquidation and get together and say, look, let's not all sell at once. We know that what that's going to do to the prices of all these names. And yet what happened, right? The ceasefire did not hold. Goldman and Morgan Stanley went ahead. And, for my money, I still don't understand. Everybody knew what the stakes were. It's sort of risk management 101 that when there's going to be a fire sale, you want to be, early, or you want to be in the first part of that. And they weren't. And so, on Credit Suisse and Nomura, was it the fact that they didn't have as large an equity sales force and an equity franchise in the U.S. to offload these huge blocks? And that was why they were more reluctant to sell? Were there other reasons, or was it just a failure of the risk management? I don't know. What we do know is what we could see, out in public, and it seems as though that they had a failing of risk management here.
Shepard Smith here. Thanks for watching CNBC on YouTube.